Greetings, time for another CrashWatch video. I have said in many of the prior CrashWatch videos that October is the month where things could start to get very, very volatile and very chaotic, and the stock market crash that we expect to happen could in fact happen in a window of time that begins in October. So here we are in October, and thus it's time for another CrashWatch update. So you see over here the S&P 500 chart. And it's much lower than it was in the prior video because it has fallen from here to here in just the last couple of weeks. It has broken through this resistance as well. So the original head and shoulder pattern from the original CrashWatch videos broke through, hit this level, and now it's going lower still, continuing the pattern of lower highs and lower lows. I have consistently maintained that the eventual bottom is in the low 3,000s, maybe even lower, but if you entered in the low 3,000s in a dollar cost averaging basis, you probably would not regret that long term. And remember, nothing in these videos is investment advice. I'm just showing you how to look at these charts so that you can learn and begin your own journey of forming your own conclusions, because this video is going to be useful months and years from now as well. It's not a video that has anything to do with anything you must do in the next day or week or any other period of time. It's about forming your own conclusions. The S&P 500 5-year chart and the quantitative easing that manifested due to COVID-19 pushed it to this unusual high, a high ahead of its time. This is a level that the stock market should only have reached by 2024, 25, 26, let's say, and therefore it's going to correct back down to its long-term trend line, but it was not a recession before this point either. Note this big fall in late 2018. This is because the Federal Reserve was tightening, and then they had to reverse tightening and print more money than ever before. The same thing is going to happen again, as I speak about in many videos on this channel through and through. They are going to over tighten, which they are already doing, get to the low 3,000s or lower, and then we return to this normal longer term trajectory. Dollar cost averaging into an index like the S&P 500 or the NASDAQ or the Russell 3000 is by far the best investment strategy for the vast majority of people in relation to chance of good returns, low stress, low mental overhead, simplified taxes, lowest chance of IRS audit or tax authority audit, whatever country you are in, and so forth. So the S&P 500 is progressing on down because we are getting down to the slippery slope of Federal Reserve tightening causing too many problems that cause a stock market correction and a recession. Some say we're already in a recession, some say we're not. That question is complicated because we are in a situation of high NGDP, nominal GDP, but negative real GDP, because inflation is a little bit higher than average, therefore creating NGDP that is not very low, but real GDP that's still negative. That's why we don't see job losses and layoffs to a large degree. But there's another problem that is also pressuring the S&P 500 and the stock market as a whole, which are treasuries. So we go to that next. This is the 10-year US Treasury Yield, which I often use as an indicator of inflation in some other videos on this channel. What it means is that this yield is what the US federal government will in fact pay on debt it issues, and it issues debt because the US federal government spends more than the taxes it collects. And that delta is known as the budget deficit, which gets added to the national debt, and we pay interest on the entirety of the national debt. And this 10-year US Treasury yield was unusually low during COVID, as little as 0.58%, but now it's risen to 3.8%. That is pretty high. It's not high compared to decades of time before 2018 or so, but it is high relative to what it was for a lot of the last 3 or 4 years. And this causes mortgage rates to also rise because they are all in the long-term debt instrument complex. So we go to mortgage rates. This is the 30-year mortgage rate in the US. Now, if you bought your house many years ago and have no intention of selling, you can just ignore the fluctuations in house price that occurs due to low mortgage rates during COVID and then the steep rise that we've seen now. However, this rise is so steep that if we take a longer term chart, 10 years, you see that there is no rise this steep in the last 10 years or even in the last 40 or 50 years. Even the 2008 housing bust was just because it was at a plateau for a relatively long time, not because we had a rise this steep. This steep of a rise is extremely negative for housing prices. Mortgage rates have risen by a factor of 2.5 times. Therefore, whoever bought their house within a period of low rates in 2020 and 21 over here, they overpaid for their home price. I explained that in great detail in this video up here. This is a two variable equation. Buying a house when mortgage rates are low and have been low for some period of months is a terrible thing to do because it's a two variable equation. Your payment on a 6% mortgage at $500,000 is the same as your payment on a 3% mortgage that happens to be $1 million. Therefore, buying when it's $500,000, and then when rates go down, the value of our house goes up because the underlying price of the debt instrument went up, and you make that $500,000 while your payments stay the same as what they were when it was $500,000 of a mortgage, and you can refinance at the lower rate. It's a two variable equation and a two-step process to make home equity gains in the United States and in many other countries as well. The fact that people buy when rates are low with no awareness that low rates are simultaneous with an increase in the underlying price is going to hurl many people into negative equity. This is going to be a problem because unlike 2009, 10, 11, the same quantitative easing that the Federal Reserve did, which was buying MBSs to artificially prop up the mortgage market, will no longer work because that has stimulated more construction of housing, and the mortgage rates were close to their theoretical minimum level. The only quantitative easing that will rescue the economy from this situation and the recession caused by it is quantitative easing in the form of cash sent directly to people. The Federal Reserve got to the point that it owned 40% of the entire mortgage market, and therefore people who had mortgages before quantitative easing made free money, and people who either paid off their house in full or, even worse, did not have a house made none of this money. That is very unfair. It is just too complicated to be organized into simple political memes, and our politicians aren't smart enough to do that. This is very bearish for the US economy and will pressure the S&P 500 down further. And I speak about this mortgage rate in a bunch of other videos. Now for the final chart we're going to go to, we're going to see the VIX Futures complex. This is the VIX Central website, and these are the VIX Futures with the nearest month over here called the front month, which is October. It has 16 days to expire, and these are calendar days, not just trading days. So 7-day weeks, 16 days to expiry. It always expires on a Tuesday, and these futures are in backwardation, meaning the second month is higher than the first by this percentage amount. 1.58%. This state never lasts for a very long time, but the VIX, the green line, is a measure of how much people are willing to pay for put options on the S&P 500. Put options are a form of protection against a sharp decline. They are willing to pay a lot right now, but not an unusually high amount. 31 is a pretty high VIX number. The median is usually 19 to 20. 31 is pretty high, but not super high. High is anything above 40, and crisis level is something like 70 or 80. But these futures indicate that a lot of put buying has occurred, and there is pressure for this futures complex to slip into steeper backwardation. The fact that that has not happened in the last few days leads me to think that these futures will rebound a little bit, causing the S&P 500 to have what is known as a dead cat bounce, a small rally right before it makes newer lows after that. But don't do any trades based on this. This is just a way to look at the futures complex and see how you can use this as a predictive tool. VIX futures in backwardation is usually a sign of very bearish market conditions, but also a state of conditions that cannot last for very long, because if futures are in backwardation for a long time, then eventually even the longer term complex rises, and then you have a big stock market rally in the months and years following that. But these are the VIX futures and the contango or backwardation that they reside in. Right now, backwardation. If the front month were lower than the second month, that would be called contango, as we see over here. Negative contango means backwardation. Anyway, that was a lot of information in a CrashWatch video, and at some point I'll have more detailed instructional videos about how to interpret all of these things. But this is the more tactical, short-term education about market conditions at this exact point, October 2nd, 2022. Thank you very much for watching.